Well, hello again, everyone, and welcome to our first webinar for 2017. For the ones who have participated in previous webinar, welcome back. And to all of you who are attending for the first time, thank you for joining us, and we hope that you attend more webinars throughout the year. So this is our first webinar for this year, and this webinar will shed light into a new market opportunity in focusing for low-cost schools. Some of your organizations might already be lending to local schools and have more experience. So we will please, all of you, please, if you can send us questions, we would love to hear from you, your experiences, your challenges, and we can take it up to discussion when we will have our Q&A in the end. So before we start this webinar, I want to introduce myself and our presenter. So I'm Alkis Theodori, and I'm a senior associate at the capacity building team with CapPlus. We are delighted to have here today Ms. Fran Mice, the director of capacity building team at CapPlus. So I'm going to talk to you a bit more about Ms. Mice's experience. So Ms. Mice is a development finance expert with over 25 years of experience in building and growing financial institutions, financial and business development services to micro, small, and medium-sized enterprises. Her areas of expertise include product development, market analysis, program design, and institutional assessments. Recently, she established and managed the Women's Entrepreneurship Development Program in Ethiopia. As you'll hear today, low-cost private schools are small businesses facing issues similar to all small businesses, yet they have a potential creating a well-educated workforce for our country's future. Many of you know CapPlus, but for all of you who are here for the first time and have just minimal information about us, I would like to tell you more. So CapPlus is a non-profit organization that works with financial institutions to strengthen their services to small businesses. We have been working for more than 10 years, and we have delivered mutually reinforced interventions that help financial institutions increase their effectiveness, scale, and profitability. As you'll hear today, we will talk more about this new financing opportunity for low-cost private schools. But I want you to check your screens right now, and you will see the results that we have been delivering for more than 12 years. We've had a lot of clients in more than 30 countries, and we work with different banks in different regions. So with this information about CapPlus, we want to start the webinar now, so I will hand over to Fran in order to start a presentation about financing low-cost schools. Fran?
Yes, thanks, Alkis, and welcome to everyone. And just want to check if you can hear me, Alkis?
Yes, we can hear you loud and clear.
Okay, great. So today we're going to cover 4 topics on what we feel is a significant market opportunity to lend to low-cost schools. And this is based on research that CapPlus has conducted over the last year. And first we're going to look at the market demand for actually financing low-cost schools. And then we'll move to discussing how low-cost schools can be a profitable SME segment for financial institutions. Then we're going to look at and review the loan characteristics and challenges to lend to these private schools. Finally, we will discuss some lending approaches that financial institutions may want to take. First, we're going to kick it off by, I'm going to ask Alkis to ask a question of you.
Thank you, Fran. So we'll start with our first poll of the day, and you will see it popping up in your screen. So the question is, in sub-Saharan Africa, what do you think is the percentage of household expenses that are associated with primary education? So the polls are open, and you will see 5 choices that you can select one of them. So it's 20%, 30%, 40%, 50, or 60%. So the poll is closed and we have the results. So we have some mixed results for this poll. The majority of you said that 40% of the household expenses are associated with primary education. And then we have 30%, 35% of you said 30%, and then 20% of you said 20%. So we have very mixed opinions about this one. So I will let Fran explain more about this question. Fran?
Well, good. It seems like the majority have read the study where this figure comes from, and it is 30% of the household expenses are associated with primary education. And this information is from a report by UNESCO entitled Financing Education in Sub-Saharan Africa. So we'll just keep that figure in mind as we move on to our presentation. And first, I want to just take a moment and explain what the resources that we're using for the information in the presentation. And it actually comes from 4 different sources. So the first is an online survey that CapPlus did with 77 financial institutions. And there's different types of financial institutions we talk to, but for simplicity's sake, I'm going to just use banks as the term. But we did talk to microfinance institutions and non-bank financial institutions, but we'll just refer to that whole basket as banks. And these 77 institutions came from across Asia, Africa, Eastern Europe, and the Middle East. So it's kind of a wide spectrum. And then from those 77, 29 of those, we did a bit deeper dive with them and received more detailed responses. Secondly, we did in-depth interviews with 14 bankers. Third, we actually did in-person surveys of 995 school proprietors in 5 African cities. And those cities included Abuja, Dar es Salaam, Kampala, Lusaka, and Nairobi. And lastly, we've used some research that was done for 55 school proprietors in Lagos. And this was done by a project called Deepen, and it was a program sponsored by DFID. So in the market research conducted in Abuja, Dar, Kampala, Lusaka, and Nairobi, we really only talked to schools that were located in the low-income urban areas, including the slums and the informal settlements. So throughout the presentation, I'm going to be referring to registered and unregistered schools because there is some difference between those, and it's basically based on what the Ministry of Education in those countries have for their standards for schools. And if a school is unable to meet the standard, then they would be classified as unregistered. But what we find is that some of the Ministry of Education requirements can be quite stringent, such as requiring the schools to have playgrounds or actually owning the land that the school is on. So in some cases, it's very, very challenging for the schools to meet the standards of the Ministry of Education. Let's go on to what's the low-cost schools and how they play a major role within these cities. And what we find is there's a really deep demand for low-cost schools. And families at all socioeconomic levels send their children to private schools, believing these schools can offer a superior education for their children. And so these private low-cost schools can really fill the gap of education in these growing, densely populated cities, sometimes more quickly than public schools. And according to the figures that you see, there is really growth potential for affordable private schools based on this demand. What we've seen is that new schools have been started at rates of 6 to 20% per year, and that the enrollment at private schools is actually growing at a faster pace than public schools, even though in some of these cities, the public schools are tuition free. And we realize as the private schools grow, so does the access to affordable quality education. And to some respects, we're seeing that the governments are actually starting to recognize the need to encourage this private sector investment in private schools. Now, low-cost schools are rather unbanked, even for just having a dedicated school bank account. And what we want you to see in this slide is that if you just look at the blue sections of both the left-hand and the right-hand side, you can see there's quite an opportunity for the banks to work with these schools. So the blue indicates that in the left-hand column, the number of bank accounts that banks could open for these schools, because the blue means that they don't have a bank account. On the right-hand side, you can see that very few schools have ever even had loans. So the blue area shows that there's a tremendous opportunity for banks to work with these schools in providing them financing. Now, what we've learned is that low-cost private schools in the 5 African cities that we studied have a cumulative demand of more than $1.3 billion in financing, and that's based on over a 3-year period. And that includes both what we talked about, registered and unregistered schools. So there is a huge untapped market opportunity for the banks. And basically what we're seeing is that affordable private schools can't really keep up with the student demand, in part because they have a lack of access to credit to expand and improve their facilities and just improve the quality of their education. Now, we talked about the program in Lagos through the Project Deepen, and if you just add that city, the unmet demand can go up to $4 billion. So I'm going to stop and ask Alkes to join us again and ask you another question.
Thank you, Fran. So we're going to have the second quick question for the day. And so we want to ask you, in the 6 major cities that Fran already mentioned, Abuja, Dar es Salaam, Kampala, Lagos, Lusaka, and Nairobi, how many children are attending private schools? So let's see what the majority says about this question. So we have the majority of you, the polls are closed now, so I have the results, with 47% said 5.3 million. And then very few, like 12% and 18% of you said 1.5 and 4.6 million. So Fran, we have a majority of 47% saying that 5.3 million are attending private schools. Can you please take it from here?
Yes, thanks, Alkes. Actually, that's really, really close. The figure is just shy of that at 4.6 million. Children are attending private schools, and this table gives you a breakdown by city on those that are attending private school, keeping in mind that when we talk about these private schools, we're primarily talking about the primary level. And just to point out, so Kampala does have the highest level of children attending private schools, whereas Dar es Salaam is the lowest at 20%. But overall, we feel confident in saying that the low-cost private school market is stable, it's growing, and it's looking to expand. Okay, let me go down. So CapPlus estimates that there are currently 31,000 private schools. And if you look at the far right-hand column, that gives you an idea of the growth rate of the schools. And we expect this number to continue to grow. And education, we believe, is a growth sector. And many countries are enjoying rapid growth in both the number of private schools and the percentage of school-age children that are going to these private schools. And so all told, this market expansion creates this demand for the school financing at $4 billion. And that's, again, over a 3-year period. So we believe that financing to low-cost schools can be a profitable SME segment for the financial institutions. based on the in-depth interviews that we did with the bankers, we wanted to show you some of the results from those interviews. And 87% of those interviewed felt that they were already lending to schools, that they were going to increase their current portfolio of loans to schools. 73% expect a medium to large demand for school financing. And then 79% who are not lending are actually ready to initiate lending to low-cost schools. So these figures are a good indication that financial institutions see opportunity to lend to private schools. Now, if we break that down and just look at those financial institutions that are already lending to private schools, we wanted to just show you, first of all, you could see the different types of financial institutions, even though sometimes I'm just saying banks, but there are different financial institutions that are lending to private schools. So as we said, 87% of those 77 financial institutions interviewed are already lending. And we just wanted to show a bit of a breakdown of those institutions. So if you look at just the asset size of these institutions, they're tiny, ranging from tiny to huge, ranging from just 132,000 in assets all the way up to 87 billion. So it's quite a wide range of financial institutions. You can't just say that small institutions will lend to private schools. So even the bigger banks are lending to private schools. The loan volume is quite a range. It can be anywhere from 50 to 400 loans per year, just to kind of give you an idea of volume of lending that could be expected. Now, average loan size, it's a bit skewed, with commercial banks having the highest average loan size, which was greater than $50,000. Now, depending on your market, this could be smaller or larger. And then if we look at interest rates, they appear rather healthy and should give the banks a decent spread. And the interest rates that were reported range from 12% to 42% annually. Now, we know that there are some similarities in lending between low-cost schools and then your just typical SMEs. But there are some uniqueness to actually lending to schools. So unlike most SMEs, schools are regulated by the Ministry of Education, which adds another factor to your loan underwriting process. In addition, there's an interdependency between the cash flow of the school and the quality of the school. And what you find is that, of course, satisfied parents are going to keep their children at a school if they're satisfied with the quality of the school. Conversely, if they're not happy with the teachers and the quality of the school, then they can move their child to another private school. I mean, it's competition. And the quality of the school is going to determine what the enrollment figures are and then eventually what the cash flow would be. So the bank managers we surveyed acknowledged that their staff, their internal bank staff, really don't have the skills to assess the quality of the schools, and we'll be talking about that a little bit. And lastly is about the collateral. Of course, all banks universally are going to want small business to have collateral. But with schools, it might be a little bit harder to foreclose on a school if it can't meet its debt obligations. So there could be a reputational risk to the financial institution. So we'll have to figure out how to overcome that challenge. And I'm going to stop a moment and ask Alkis to join us again and ask the next question.
Thank you, Fran. So we're going to ask you, what do you think, what do financial institutions say that they need to grow or initiate their portfolio of low-cost school loans? Select one of these 5 choices and we'll close the polls very shortly. So the polls are about to close, and we have the majority of you saying that all of the above are very important for a financial institution to initiate or grow their portfolio. So 52% of you voted for the last option, But we also have a very good majority of you, I would say 33%, saying that partner with expertise in education, it's also important. So, Fran, we have two important points coming out from this poll. I'll let you take it from here.
Thanks, Alkis. Actually, this is really interesting because it is correct that it is all of the above, but I'm kind of surprised that nobody felt like additional capital was needed. So maybe the banks are more liquid than we thought. And let's look at, we have our information broken down actually by those banks that are already lending to schools and those that are just interested in lending. And it's interesting because the first answer for those already lending to schools is that they need additional capital. And yet nobody responded to the additional capital. And with that additional capital, the banks that we have met is that they prefer it in the local currency and for longer terms, because as we're going to see, the usage of the loans that the schools need, they might need longer terms. So you want to match the capital of the bank with the needs of the schools. And then those that are already lending, secondly, they realize that they do need to mitigate their risk by having partners, such as quality education providers, to work with the schools to develop the school skills and quality levels. So it's good that 33% of you noted that was also an important point. And then thirdly, they also needed technical assistance and market data, which, again, it's surprising that nobody selected market data on the poll, because if you look both at those already lending, just over half said they need market data, and for those interested in lending, they really need some additional market data. They want to have a bit deeper information about those schools that are in their areas, and to understand them, to develop their policies and procedures so that new products, that they have a better idea of how to lend to these schools and develop their manuals and their processes. So good. Let's move on here. We're going to move on to loan characteristics and challenges. So we're going to look at the profiles of some of the schools that we interviewed, and just to give you a bit of an idea of what those schools look like. 80% of the schools that were interviewed are actually sole proprietors. And women entrepreneurs actually represent 40 to 52% of the schools proprietors in our survey. And this is just to kind of give you the table that you see. It's just showing you by city of what the numbers look like. Now, primarily the schools are run as private businesses, for profit. These are not charitable operations. And in all but one city, more than 79% of the teachers met the Ministry of Education regulators' definition of qualified. So that's a really good indicator for our banks to know. And even though this is considered, schools are considered an unbanked sector, there are some 41 to 67% of the schools did have a dedicated school bank account, which is good for the banks to know. And finally, between 36 and 64% of the schools report that their parents' payments are mostly regular, whereas the others feel like they have to chase the parents to collect the fees. So that falls under your cash flow. Now, on the other hand, the bankers we interviewed said that they felt like the schools generally had stable cash flows because parents had to pay the school fees in full at the beginning of the term. So there's a little bit of different perceptions from the school sides and the bank sides about whether or not the school has regular cash flows. So I'm going to invite Alkis back to do our next poll.
Thank you, Fran. So this is the last poll of the day. And the question is what is the school's biggest credit need? Okay, so the majority of you said that 65% of the votes came for remodeling or construction. Then we have 13% for buying land, 4% for buying buses, and 17% for buying office supplies. So we have a good majority, friend, that thinks that 65% of all attendees in our webinar think that the school's biggest credit need is for remodeling or construction. Are they right on this question?
They are indeed. Thanks, Alkis. Yes, this is correct, that remodeling and construction is the biggest credit need for the schools. And for the most part, out of the 995 school proprietors we talked to, we asked them if they plan to borrow over the next 3-year period. And if they did plan to borrow, what was the purpose of the loan? And the highest response was for some kind of a fixed asset. And as you can see, that the different needs for the fixed assets by city, that they vary by location. So this just is in part reflecting how the different regulations, the school regulator requirements, and also the uniqueness of that market. So that's why you see some differences in these figures. For example, that for some schools they wanted to buy land because in that particular country it was a requirement that the school buy land. So if you look specifically at Uganda's responses, schools are not required to have land. So that's why that figure is rather low, whereas in Nigeria the schools are required to buy land, and that's why they have a high demand. Basically, overall, it's clear that schools want to borrow to expand or improve their facilities, which in the end would allow them to serve more students and subsequently increase their school fee income. Okay. Now, we wanted to look at the age of these schools in terms of how long they have been in business. So even in a rapidly growing industry, the private schools have had some longevity. So 64% of the schools we visited are at least 3 years old, and 29% are actually 10 or more years old. And the graph that you see actually combines both registered and unregistered. So really, when you're talking about SMEs, 3 years is a good amount of time for a school to be in business. And even the unregistered schools have a long tenure, with 30% are over 5 years old. So even though they've been unregistered, they've still been able to keep in business. And this history and experience of the schools should reassure the banks who would even want to lend to unregistered schools. And in Kampala, they have the oldest market with 57% that are 10 years old. And Abuja and Dar are the youngest markets, with Abuja has 44% less than 3 years, and Dar has 57%. So many of the schools are unregistered, and we've been talking about registered and unregistered. And the patterns you see here in this graph just reflect the different regulatory requirements and different growth patterns in the cities and school markets. And what you see, for instance, we've talked a little bit about Kampala, that they really have the most flexible educational regime. And so you will see that they have quite a high number of registered schools. And additionally, in around the 1990s, the private school industry really took off in Kampala. So the private schools have had time to meet those requirements of the Ministry of Education. Now, if we look at Dar es Salaam, their public primary schools are tuition fee free. And the private schools in Dar are generally more pre-primary. And they're relatively a new phenomenon, with 55% are 3 years or younger. So in Dar es Salaam, the schools have to own 5 acres of land to become 5 hectares of land to become registered. And then if you look at Nairobi, they also have a way for informal schools to be registered, and they have a higher indication of registered schools. So we know that the schools face some challenges, and we just want to highlight those a bit. That the highest challenges faced by the school proprietors really have to do with school finances. And the main issue that the schools tell us is that they have difficulty in managing this somewhat erratic cash flow because they're working with parents that may not be regularly paid. And secondly, their second biggest challenge is actually accessing loans for financing for the development of the school. Let's just move to lending approaches. And we want to discuss how the banks can have their own techniques to mitigate some of the risk that we've been talking about. The banks that report applying these practices feel like these could mitigate their risk. So from the bank side, they feel like they only want to lend to schools registered with the education ministry. They feel like if they use this registration status as a de facto risk assessment tool, since the registration actually involves a vetting process. Secondly, the banks are primarily lending to larger, more established schools, and they feel like those schools can demonstrate that they have cash flow, and the banks can do their analysis to assess the school's capacity to repay. And finally, what they're doing to work around the collateral issue, as we talked about earlier, is that most of the bank managers explain they really want to lend to, they wouldn't lend to a school without some kind of collateral, even if the collateral belonged to the school proprietor. Okay, so in conclusion, CapPlus believes that financial institutions can capture more market share in low-cost private schools, and they can achieve faster growth within this segment based on if the banks are able to develop an integrated set of products and services which are specifically tailored for the private school segment. Now, keeping in mind that it's shaped for the local markets and that country-specific policies and procedures are put in place. And for instance, we would suggest that the loan products are tailored and designed to meet the school's cash flow patterns, because we know that their cash is maybe only coming in over a 9-month period and that they have unique needs for their loans. Another way to design some products to meet the reality of schools and then the families they serve is to potentially bundle services. For instance, the bank could provide school fee collection services, they could provide transaction services to schools, or maybe there's some even technology solutions such as mobile payments for school fees. Secondly, we feel like there could be some opportunities to cross-sell, and some financial institutions require schools to keep a deposit account for tuition fee collection. So we saw in the graph before that many of the schools had a bank account. And other financial institutions are actually cross-selling insurance products to the schools or offering loans to the school staff. And while not an active product for any of the interviewees, some did mention the possibility of tuition loans for families. Now, while these types of integrated products and services, or with these integrated products and services, the banks can have a broader relationship with the private schools. And we feel like registered schools are actually low-hanging fruit, but unregistered schools also have a big demand for credit that could be met if there was some modification of the underwriting approval process. So we feel like it's in the bank's best interest to establish partnerships with organizations who can provide non-financial services to help the schools improve their financial management and learning outcomes. Because we saw before that there was this need to have some partnerships. And those partnerships could greatly reduce some of the credit risk. And through regular engagement with Ministry of Education regulators, the risk in lending to unregistered schools could be reduced. And we know the banks may not engage with the ministries directly, but through their partnerships with other organizations, they could do that. So to recap on the webinar today, we feel like this is a presentation that's showing that low-cost schools, lending to low-cost schools is a market-driven approach based on increasing market demand for financing of low-cost schools. We discuss how lending to these schools can be a profitable segment. We reviewed a bit of the loan characteristics and challenges of lending to these low-cost schools and some approaches that the banks could adopt when lending. And CapPlus can be your partner to provide the capacity building to develop best practice and actionable advice for financing low-cost schools in a profitable way that also will give the financial institutions a social impact. And CapPlus is going to be starting to work on this type of partnership for proof of concept in 2 to 3 countries, and then we hope to scale it up to 10 countries. That is the end of the presentation, and I'm going to turn it over to Alkis.
Thank you, Fran. Thank you for this very informative presentation. And now that the presentation is done, we are going to open the floor to Q&A session, and you're welcome to type in your questions. We already have had some questions coming in, so I would like to start with some of those, Fran, if you're ready.
Yes, please.
Sure. So we have a couple of questions, and the first one that came in, and it was already mentioned in some slides of the presentation, but just if you can give us some more details. So what type of collaterals can be used in financing to low-cost schools? Because you mentioned that the inadequate collateral is the reason why banks don't give loans to schools. So what typical does end up getting used as a collateral, and if at all, are all loans usually mostly non-collateralized?
Okay, so I would say that most loans are not uncollateralized, that the financial institutions are going to want some kind of collateral. And what we would say is that at least that they look at the school, if there's a way to get the information about the school, if there's some property deed on the school, and if that's not the case, then they look to the proprietor and look at their collateral to see what that proprietor has. Maybe the proprietor has a building or a house or a vehicle, something that, or even some deposit account. So those are the types of collaterals that the financial institutions could look at.
Thank you, Fran. I'm looking at the other questions coming in, and we have another question for you, Fran. So this is like a two-part fold question. So is it possible if you can give us any examples of current banks that are giving loans or they are financing low-cost schools? So this is the first part of the question, Fran. The second part is that if you can talk a bit more in details about the insurance products that you mentioned throughout your slides.
Okay, good. So actually, we have done some research on 2 institutions in India that are non-bank financial institutions that are only, their main focus, their main target is giving loans to these affordable schools. And I believe in both cases, their loan portfolios are about 2,000 each for the number of schools that they are lending. And I actually was at a school last week in East Africa that was receiving a loan from a non-bank financial institution. And it was interesting because this non-bank financial institution had taken them many months to convince the school to shift from their current financial institution to come over to their financial institution for a loan. So you could see in that this particular market in East Africa that there was already competition amongst the financial institutions to get this school's business because they saw them as a good borrower. And then the second question about insurance, I'm going to have to defer that specifically. The same financial institution that I visited that was giving the loan to the school, they have a sister company that offers insurance. Now, as far as the very specific details of that insurance, I don't have that at present, but we can find out a bit more about what those insurance are. I believe that there's some life insurance portion, but it doesn't come directly from the lending side of their institution, but it comes from their sister company that only offers insurance. So they cross-sell within the larger organization. The one side is doing lending and the other side is doing insurance.
Thank you, Fran. Thank you for your detailed answers. So we hope Ashwin is good with these answers for Fran. Please feel free to ask any other questions. If you want more details or you have the emails in the presentation, you can contact us for more details, especially about the insurance part. We can get more answers for you. Thank you, Ashwin, for being participatory. So we have other questions. The next question is from Cecilia. So she's asking, what do you suggest the local school lending to be a standalone business or part of an FI's existing micro or SME business?
Oh, okay. I would suggest that because low-cost schools are an SME business, that I think that they could be a part of already the ongoing SME lending that the financial institution does. What I would further suggest is that they keep a bit of track of those low-cost schools under their small business lending, just because if it's a new product for them, that they want to see how it goes and see the number of loans and the volume that they're doing. But I think that many of the basic procedures of looking at an SME and with your underwriting is going to be rather similar to the SME lending that you're doing. As far as the schools, as we noted in one of the tables, there is a little bit differences with the schools. And since many of the schools are requesting some kind of construction loan, that generally means a little bit different terms for the loan. Perhaps there could be a somewhat of a grace period, and then it might have to be a longer loan since it's considered more of a fixed asset. So otherwise, I would say to put it under the SME business, but just as like a subset.
Thank you, Fran. We just got another question from Mashur Ali, and the question for you is, how do financial institutions manage repayments if schools are free of cost for students? So this question might be a bit out of context here, I would say, but Fran, if you have any comments for that.
Right, I would say that, I mean, the school is going to have some kind of income or revenue to repay a loan, and if the tuition is free for the students, then as from a financial institution's point of view, I'm not sure what they would be lending against if it's free. Now, perhaps if the school receives some subsidies from maybe some charity or nonprofit, then that, I guess you could lend to them. But my first reaction is the same as Alke's, that you probably wouldn't want to lend to them if they're not receiving some kind of tuition. And that would have to be up to the financial institution if you would consider that school to give them a loan if they're not receiving tuition, but maybe they're receiving some other form of income to run the school.
Yeah. Thank you, Fran.
Yeah, and I'm just thinking just one other point. The thing is that you would have to, you would almost then be giving the loan to whoever this third party is that's providing the money to the school to run. So you'd have to think about that. And actually, there's somewhat the case that we saw in Bangladesh that the banks are, we're researching this a bit more, but as we understand, the banks aren't able to give a loan to the school. However, they can, as an entity, however, they can give a loan to the actual owner of the school. So it would be the loan would be between the bank and the owner, not between the bank and the school. So there could be, it could be very country specific on that kind of issue.
Thank you, Fran. We're having another 10 minutes for this Q&A, so please feel free to type in any other questions that you might have, or if you want to participate immediately, you can just tell me and I will unmute you so you can talk directly to Fran if you need to. We have another question that just came in, and it's about the income cycle of the schools. So the school generation income cycle gets distorted during the summer months, and we all know this. So during these 3 summer months, the schools do not generate any income. So what would you suggest it can be worked around this for any repayment plans with the financial institutions?
Great, that's a very good question, and it's all, any kind of business that has what is almost like a seasonal income pattern, as we would see in agriculture and so on, that you're going to have to look at their capacity to repay, look at their cash flow analysis to see when that income is coming in, and if your core banking systems can allow you to perhaps change the payments such that during their months that they're receiving the tuition, that the payment might be higher, and then the months that they're not receiving any tuition payments, you could make those payments a lesser amount. And so there could be some workaround within. Again, it depends on what your systems allow, what your risk managers will allow you to do within your institutions. If there's some way that you can just decrease the burden of the loan servicing during those periods of time that they're not receiving income. I think that if they can at least make some kind of payment rather than just giving them that grace period during that time, at least to just have some payment as a practice for the schools that they know they have to make these payments every month.
Thank you, Fran. Thank you for the detailed information. So we have a couple of more questions coming in. For the FIs that are planning to get into low-cost school financing, what do you think are some key things that they need to look into before they start thinking of going into the low-cost school financing?
Okay, good. That's a good question. And I think that some of the first things that they need to do is to get that market data. We have some research more at a higher level that CapPlus has done that we'll be sharing with our financial partners. But I think that it's important to dig down a bit and really see the number of institutions, what those look like according to the branch network of the bank. And I think you need to find out, looking at deciding, are you going to give loans to registered and unregistered schools? Do you want to just start with one level of type of school? And also I think to look at who could be these partners that you could work with on the quality education side. And the work that CapPlus is doing, we've already identified some of these quality education providers in the different countries, and we will be coordinating with the financial institutions on these partners. So these are the initial kinds of things I would suggest to look at, and then as you go on, and this question that we just talked about was if you're willing to do some kind of irregular payments for the schools while they are not receiving tuition fees. So these are the kinds of operational issues that you should look at in your policies and procedures.
Thank you, Fran. We've been receiving a lot of questions in this last 10 minutes of the webinar, so we'll try to get through them as much as possible. So I'll try to be more good with this quick replies to the question. So we have a question from Sarah, and she's asking, how can banks best train their staff to measure quality of education? What indicators can banks be expected to capture to evaluate quality of education during the underwriting process? I think Fran already mentioned some of the quality of education during her presentation, but I'll let Fran to just talk a bit more about it so she can reply to this question.
Great. Thanks, Alkes, and thanks, Sarah. That's a great question. And actually, that's why we feel like these partners are needed that are already working on the quality education with these private schools. And firstly, there might be some kind of a rating within the country of these schools. It's pretty rare so far that we've seen, but there could be some information available either through the Ministry of Education about the rating. And I would say that would be the first step, is to have some kind of some relationship with the Ministry of Education to find out what the status is of those schools and if they do any kind of quality measurements. And as far as within the underwriting process, the indicators, we're starting to work on that actually just now. And as we begin to work with a couple of financial institutions in East Africa. And I think that that's going to, we don't want to burden, we wouldn't want to burden the banks with too many indicators about the quality of education. So we're trying to figure out how to do that within the underwriting process that is doable for banks. And so that's underway, and we hope to be sharing some of our lessons learned as we move along. So Sarah, stay with us, and we'll be getting back to you on more detailed answer on that.
Thank you, Fran. So we have just 4 minutes left, and I have received a lot of questions. So unfortunately, we cannot reply to all of them. I will have time just for one more question. And please, everyone is more than welcome to email us or in the post-webinar survey if they can write their question and we can follow up with them with more information. Please feel free to do that. We would love to get back to you with more answers to your questions. And we will also have more covered on this webinar topic in our LinkedIn group. So please, if you can go to LinkedIn at CapPlus Exchange, you can find more discussion about this. So the last question for you, Fran, comes from Rita. And she's asking to clarify, where does CapPlus stand in the low-cost school financing? Do we provide technical expertise for schools, or we are just partnering with financial institutions and providing TA for the financial institutions?
Okay, good. Thanks. Good question, Rita. That is actually, we will be partnering with the financial institutions to provide them technical assistance on lending to low-cost schools. At the same time, we are partnering with these quality education providers, and we are also planning to meet with the Ministry of Education officials in the different countries where we're going to work. So we want to kind of provide this coordinating role between these three bodies. But more closely, we'll be working with the financial institution on policies and procedures, and working closely with their relationship managers, their loan officers, their back office support on how to underwrite these loans and to track them.
Well, thank you, Fran. Thank you so much for all the answers to all the questions that we received today. And thank you for everyone that was part of this webinar. This is our first webinar for 2017, and we will have many more to come. Thank you to everyone who participated with their questions, and sorry to the ones we couldn't answer back because due to the time constraints. Please feel free to email us or write anything that you want more information at our post-webinar survey, and we will make sure to get back to you. I want to thank again everyone for being here, and I will talk to you again in our upcoming webinars. Thank you, everyone.